Ladies and gentlemen, good day and welcome to JG Chemical Q3 and 9 months FY26 conference call hosted by Phillip Capital Private Client Group. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Dhiral Shah of Phillip Capital PCG. Thank you, and over to you, Mr. Dhiral.
Thank you, Rudra. Good evening, everyone. On behalf of Phillip Capital Private Client Group, I welcome all you to Q3 and 9-month FY26 earning conference call of JG Chemical Limited. Before we begin, I would like to mention a short cautionary statement. Some of the statements made in today's earning con call may be forward-looking in nature. Such forward-looking statements are subject to risk and uncertainty, which could cause actual results to differ from those anticipated. Such statements are based on management beliefs as well as the assumptions and the information currently available to the management. Participants are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earning conference call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Today, from the management team, we have Mr. Anirudh Jhunjhunwala, the Managing Director and the CEO of the company, Mr. Anuj Jhunjhunwala, the Whole-Time Director and CFO of the company, and Mr. Amit Agarwal, the General Manager, Accounts and Finance. I now hand over the conference to Mr. Anirudh sir for his opening remarks, and then we will open the floor for question and answer. Over to you, Anirudh sir.
Thank you, Dhiral. Good afternoon, everybody, and a very warm welcome to JG Chemical's earning call for the third quarter. I would like to thank all of you for taking the time today to join us. I will begin with a brief overview of the company, followed by some key operational and strategic highlights for the quarter and for the 9-month period. As you are aware, JG Chemicals Limited is India's largest manufacturer of zinc oxide and the country's leading zinc recycling company. We cater to a diverse range of end-user industries, which include rubber, tire, ceramics, paints, pharmaceuticals and cosmetics, specialty chemicals, and many more industries. We serve over 200 domestic and more than 50 global customers, including all leading Indian tire manufacturers and 9 out of the top 10 global tire companies. Our manufacturing network comprises today of plants in West Bengal and Andhra Pradesh with a combined capacity of nearly 70,000 metric tons per annum. We offer 80 plus specialized grades of zinc oxide, as there is no one-size-fits-all approach when it comes to zinc oxide, and each customer have their own specification. Our Naidupeta facility remains a key competitive advantage for us, being the only IATF certified plant globally and holding also the WHO GMP certification along with other pharmacopoeia certifications. Today, sustainability and recycling remain core to our business model. We focus on maximizing the use of recycled zinc, which reduces costs, reduces the energy consumption, the carbon emission, and also the environmental impact. Our circular economy-led approach supports resource efficiency and also aligns well with the environmental needs and also reinforces our long-term ESG and growth strategy. As part of a sustainability drive, we have recently commissioned a new solar power energy generation project at Naidupeta, and this helps us increase our renewable energy content. This was phase 1. Further investment in renewable energy will be done to take our share of renewable power even higher. Apart from this, we also continue to explore and work on various sustainability initiatives, and the company is fully committed to its sustainability goals. Friends, now let us look at the capacity expansion and the new project initiatives that the company is taking right now. The Greenfield project, which was already announced at Dahej, Gujarat, continues to progress in line with our planned timelines. This state-of-the-art facility will significantly strengthen our presence in Western India and also enable us to be closer to our key customers in that region. Work at the site is advancing well, with civil construction currently underway, and machinery installation is expected to commence over the next couple of months. We expect to commission this phase 1 of the zinc oxide production in the first half of FY27 itself. Once operational and stabilized, this facility will play a pivotal role in boosting our overall capacity and supporting our long-term growth strategy. In addition to this Dahej project, we have also undertaken a brownfield expansion at an Naidupeta facility to support future demand. Our existing capacity remains adequate for near-term requirements, and these expansions will further strengthen our ability to cater to the customers in future. As part of a focus on new projects and initiatives, I'm also pleased to inform you that during the quarter, we also made very significant and meaningful progress on the recycled rubber project. Pilot scale trials for a recycled rubber project have commenced, and the initial results are very encouraging. Further details on this will be made available at the opportune time. This would be a specialized product and increase the content per tire from the house of JG. Let me now dwell upon and give you a perspective on the industry scenario. As you are already aware, tire and rubber forms a significant demand contributor as far as we are concerned. Demand momentum in the tire industry remained healthy during the last quarter. The tire industry has benefited from the GST-led reforms. The reduction in GST rates from September 25 has improved affordability and overall customer sentiments across both OEM and the replacement market. Good and widespread monsoons have also revived the rural economy, supporting the two-wheeler and the agriculture tire demand across the Tier 2, Tier 3 markets. The automotive industry continues to witness strong momentum across vehicle segments, supported by infrastructure development, improving freight movement, healthy consumer demand, and favorable financing conditions. In international markets, the demand for radial commercial vehicles, off-highway tire, and passenger vehicle segments remains strong, with India now emerging as a creditable global sourcing base for these category of tires. India is well positioned now to emerge as a leading automobile hub, which is expected to act as a key growth driver to the auto ancillary sector, supported by both domestic as well as rising export demand. The demand in the last quarter has been robust, and the same momentum is being experienced in the current quarter also. Our customers today are operating on good capacity utilization. This has therefore led to leading tire manufacturers in India announcing significant capex plan of over 12,000 crores over the next 2 to 3 years, which provides us with a strong visibility on long-term volume growth. When tire invests in growth and capacity expansion, your company, JG Chemicals, is a direct beneficiary. The Union Budget 2026 presented by the Honorable Finance Minister further enforces India's commitment to manufacturing-led growth. The continued focus on capital expenditure with infrastructure allocation exceeding over 12 lakh crores is expected to improve logistics efficiency and support demand momentum across automobile and other sectors. Recently, with the trade agreements with EU and the US, we are hopeful that the export opportunities for some of our customers would also grow significantly, which had become subdued over the last few months. And thus, we feel that these customers would now again come back to higher level of productions. Apart from rubber and tire, we are also seeing encouraging traction in the non-rubber segment, such as pharmaceuticals, ceramics, specialty chemicals, and agriculture. Our focus on product customization and customer-specific solutions continue to strengthen our partnerships with them and improve our penetration in these areas. Over the long term, we remain committed to increasing the contribution of non-rubber allocation to drive margin expansion and also portfolio diversification. Overall, as a company, we remain optimistic about the long-term growth prospects of the zinc chemical business and our ability to gain more market share, driven by strong customer relationships, product innovation, our focus on sustainability, and capacity expansion. With this brief overview, I would now request our CFO, Mr. Anuj Jhunjhunwala, to share with you financial highlights for the quarter and the 9-month period. Over to you now, Anuj.
Thank you. Good afternoon once again to everyone on the call. I will now take you through our financial performance for the third quarter and the 9-month ended of the current fiscal, followed by some operational and business updates. I am pleased to share that in this quarter, your company witnessed its highest ever quarterly sales, EBITDA, and PAT. The improved performance was driven by strong demand across most customer segments. For Q3 FY26, our consolidated revenue from operations stood at 249 crores, registering a year-on-year growth of almost 19%. This strong growth during the quarter was driven by higher realization, improved capacity utilization, and increased mix of specialized orders. These factors collectively enhanced operating leverage and supported a sequential improvement in margins. In terms of key figures, the EBITDA for the quarter was 26 crores. The PAT was approximately 18 crores. Overall, the quarter reflects improved operational efficiency and stronger profitability, supported by disciplined execution and a favorable product mix. On a 9-month basis, the revenue from operations was 687 crores, EBITDA was about 71 crores, and PAT was at 50 crores. As mentioned by Mr. Anirudh, the GST reductions implemented in September have led to a meaningful improvement in demand across the automobile industry, which has obviously had a direct impact on the tire segment as well. This momentum has continued in the current quarter, supported by improving customer sentiment and industry activity. We remain optimistic that these trends will sustain in the upcoming fiscal, providing strong growth visibility for the tire industry and related value chains. In addition to this, various FTAs which have been signed between India and the West also bode well for general manufacturing industry in India. In addition to the tire industry investments which was mentioned earlier, we are also seeing various automobile and its ancillary companies announcing new capex plans in the immediate future. All this bodes well for the general demand in India, and I feel our country is fully geared up for attracting new investments from both Indian and foreign companies going forward. And to meet this demand, JGC is also expanding its capacities to ensure that it has enough capacities available to cater to the demand which will follow. With this, we can now open the floor for question and answer session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from the line of Mohit Chok from Shubh Labh Research. Please go ahead.
Hi, sir. Hope I am audible.
Yes, sir, you are. Please go ahead.
Sir, my first question is, I wanted to understand more about pricing scenario. Given OEMs have commented about offsetting the input cost pressure with volume growth and operating leverage, are we noticing some free hand in pricing to increase our margins?
Could you repeat your question, please, once again, the first part of the question?
Sir, I wanted to understand more about pricing scenario. Given the auto OEMs have commented about offsetting the input cost pressure with volumes growth and operating leverage, so we are noticing some free hand in pricing to increase our margins.
So as a company, we believe in responsible pricing, and whether the demand is muted or is in a buoyant stage, the company has very long-standing relationship with our customers, wherein any cost pressure on the company is passed on and is absorbed by our customers, and in indirect, they obviously try to pass it on to their OEMs. But having said that, I think our relationship is quite matured, that where each one, plays their part, and we do not try to take any unfair advantage of the customer. Any cost increase on the company side, definitely we try to pass it on to the customers, and because we operate in a premium segment, more often than not, it is absorbed by our customers and it is appreciated. Similarly, if there is any possibility of cost savings, etc., from our side, we also continuously try to pass it on to the customer, because if the customer benefits, ultimately we benefit in the long run in terms of value and relationship.
Okay, sir. Very understanding, sir. Sir, my second question is on the inventory side. Like I have been noticing some price increase in zinc. So if you can throw some light on how will our margin look in quarter 4 with increasing prices?
So see, as we have maintained before also, as a company, generally we are agnostic to zinc prices. Whether zinc prices go up or go down does not really affect our margin profile on the core business. Because if you understand how the pricing works, basically our product is priced on the LME, which is the London Metal Exchange, where zinc is quoted, and also the raw material that we buy is also based on the same London Metal Exchange. So in effect, it's a pass-on model, wherein supposing in the month of January, we have bought our raw materials basis the LME of January. In February, we sell our zinc oxide basis the price of zinc on the LME in the month of January. So it's an M-1 model. So technically, there is no difference in or lag in the pricing mechanism. However, when obviously zinc, when you're seeing a favorable impact on zinc prices, then we also carry a core inventory on which obviously gains can be accrued. So in the last quarter, we have seen in the last few months zinc prices going up. So obviously those gains should accrue in the current quarter on the inventory which the company carries. But generally speaking, it doesn't matter whether zinc is 3,000, 3,500 or 2,500. Doesn't matter that way.
Okay, sir. That's very helpful, sir. And sir, my third question is on rubber plant. If you can help me explain the supply chain of used tires, basically, what is the procurement channel of used tires? If you can help throw some light on it.
So as far as this business is concerned, the procurement of used tires would be both domestic and international. For international, it's a controlled mechanism wherein you need to take a license, and once you have the license, you can import. In the meantime, you are free to procure domestically. Domestically, this comes to traders and dealers who are basically scrap collectors, scrap tire collectors. In fact, going forward, there is also a model wherein as we scale up and as we set up the industrial scale, we will also look at tie-ups with large tire companies wherein their rejects and their replacements would come outflow directly to us. So that is also a model. But yes, so it's a combination of three models, directly from the tire companies, from the domestic market, and from the international market.
Okay, sir. And a last question, if I can squeeze in. If you can provide a revenue mix between tire and non-tire in quarter 3.
So the rough revenue mix, as we guided earlier, it was earlier about 90% rubber and 10% non-rubber, which became 85% rubber and 15% non-rubber. I would say we are in the 83 to 85% range for rubber, and the balance 15 to 17% would be non-rubber. And as we mentioned earlier, that as we go forward, the mix of rubber would also reduce, not because of lesser growth in rubber, but obviously rubber will continue to have good growth, but increased, more products and more application areas which we are focusing on.
Okay, sir. Thank you, sir. These were my questions. I will join back the queue.
Thank you. Our next question comes from the line of Kaushal Sharma from Equinox Capital Venture Private Limited. Please go ahead.
Hello. Hi, sir. Very good evening. Am I audible?
Yes, sir, you are.
Yes. As you said that, sir, there is no demand challenge going ahead in zinc capacity of around 40,000 MTPA, and that is being commissioned in H1 financial 27 as expected. So what kind of revenue potential are we expecting from this, and how are we going to ramp up once the capacity is online? And sir, my second question is on your recycled rubber project that we are investing in recycled rubber project. So what kind of capex are we investing in this and the capacity we are putting?
So I'll take your first question first. On the on the revenue potential from the new projects that we are doing. So the Dahej project would have a capex of total 100 crores, and it has a revenue potential of about 900 crores plus over a couple of phases. So in first phase, we'll obviously not be putting up the entire capex. It will be about 45-50 crores, and the revenue potential should be in the range of about 400 odd crores for that. And on the rubber project, I think it's still early days. We would not like to give any guidance on the revenue potential and the capex. We are working on it, and as we mentioned, it's a trial plant, it's a pilot plant right now. Once we move ahead with that, we'll share all the requisite details with the market in due course.
Okay, sir. And sir, we are also changing our product mix, like non-recycling rubber segment we are moving. So what kind of revenue mix are we expecting going ahead, like 1 to 2 years, in the revenue potential are we seeing from non-rubber segment? And could you please explain the EBITDA margin difference in both the segment if possible?
So your voice is a little muffled, but if I...
But your voice is breaking.
Yeah.
Hello?
Now is it, sir, hello?
So I've caught on to the question that he asked. So just to clarify, just to answer to his point, the revenue mix between rubber and non-rubber would change to about 70-30, I think, in the next 2 to 3 years' time. That's what our internal target is.
And sir, the EBITDA margin, could you guide, like, in the segmental EBITDA margin, how
So-
it will be shaped up?
So as we mentioned earlier, the core EBITDA margin of the company is around between 10.5% to 11%. That's the basic EBITDA margin that we aspire to make. And as we, increase the, the contribution of specialized products with operating leverage, etc., this would increase to about 13 to 14% minimum in the next 2 to 3 years' time.
Okay, sir, got it. Thank you very much for answering my question.
Thank you. Our next question comes from the line of Ashmita from Electrum Capital. Please go ahead.
Hello. Thank you for the opportunity, sir. Just wanted to understand that the gross margins have declined on a YOY basis. So could you elaborate what were the key drivers behind this compression, and going forward, what gross margin range should we look at?
So you see, as we mentioned that, in our business, there is a lag effect of materials flowing in. There's imports which happen. Sometimes there could be a couple of months lag between the, the date at which we've contracted with the supplier and the time at which the material is actually consumed. There could be certain, time differences. There could be a 3 to 4 month difference between the time of the contract and the time of actual consumption in the factory. So that's why we've always guided that rather than looking at the gross margin number on a standalone basis, it's always better to look at a lower number of, on a more operational efficiency number of the EBITDA or a PBT, because that gives a more, a holistic view of the performance of the company for the particular period under consideration. So if you see the 9-month number for last fiscal and current fiscal, our EBITDA margin is more or less in the same range, barring I think 70-80 basis point difference because of a lower EBITDA in the first couple of quarters. So I think the right way to look at our business is not just on the gross margin, but on the EBITDA margin segment, because a lot of other factors also come into play in terms of delays in usage of the material which was contracted earlier.
Sure, sir. Second question would be, could you just share the planned capex for the brownfield expansion in Naidupeta and the incremental capacity addition? I think I missed the last participant's question. I think it was related to this.
So the incremental capex would be under 5 crores because a lot of the common utilities infrastructure is already in place in Naidupeta, and approximately the capacity expansion would be for about 4,000 to 5,000 tons approximately.
Okay. And lastly would be, could you please provide the details on the volume growth for the quarter and 9 months for zinc oxide?
So as a company policy, due to confidentiality reasons, we do not disclose exact volume numbers, but I'm happy to say that we have registered double-digit volume growth in our zinc oxide business in the current period.
Sure, sir. Thank you. That would be it from my side. Thank you so much.
Thank you. Participants who wish to ask a question may press star and 1 on the touchtone telephone. Our next question comes from the line of Deep Gandhi from iThought Portfolio Management Services. Please go ahead.
Yeah, hi sir. So firstly, I think you highlighted that there were some kind of inventory gains due to zinc price increase. So can you quantify the amount of inventory gain in Q3?
So as I mentioned, that the zinc prices rose in Q3, so the inventory gains for that weren't really much accrued in Q3. They would rather flow in bit by bit in Q4, I would imagine.
Sure. And so just again continuing on this question and talking more about the balance sheet. So I mean, historically, if I see our cash flow conversion has been quite poor because I think our main raw material is zinc, whose prices are quite volatile. So I mean, in this environment, when the zinc prices have increased quite significantly, so going ahead, do you think you'll have to increase the quantum of debt in order to manage the working capital?
So currently, if you see our balance sheet, we have over 150 crores of cash and cash equivalents in the company. Further, if you see the cash flow generated from operations in this particular 9-month period is fairly healthy. So obviously ours is a business which requires about 100 days of working capital. So if we increase our turnover by say 200 crores, that means we need to have about 60-65 crores of incremental working capital. But if we are doing a turnover of say 1,000 crores and with an 11% EBITDA margin, we are more than the cash flow that is generated from the business is more than sufficient to finance any incremental working capital requirements. So there's absolutely no question of taking on any debt because the company anyways has surplus cash, and the current cash flows and the future cash flows that we plan to generate should more than sufficiently take care of the working capital financing that is required.
Sure, sir. And so coming on to the new plant, can you first highlight what utilization are we currently operating at? And then maybe I'll ask my other question.
So currently our utilization would be in the late 70s of the achievable capacity. And we've always mentioned that, our target is to be in the 80-85% range, 85% to 90 max is what we like to do. And that is why, as a matter of, our prudent strategy, we always believe that our capacity expansions and our projects should get commissioned before our customers start commencing their new projects. So we believe that in this current calendar year, 2026, we will commission the Dahej plant. We will also increase the capacity in Naidupeta. These put together would add a reasonable amount of capacity, which would cater to the incremental demand from the tire companies, which will start, trickling in large numbers from 2027, 2028 onwards.
Sure. And when you mention 80, 85, 90%, that is basically the achievable capacity, not the nameplate, right?
Yeah, absolutely. We are most happy at 80-85% achievable capacity utilization. That's for a chemical plant. That is at best one should imagine for efficient running of the plant.
Right. And so what will be the difference between the nameplate and achievable capacity? I mean, is there a 15-20% gap, or what is the range of that?
Yeah. We handle complex scraps. So this is zinc scrap that we are increasingly using more and more of scraps instead of virgin. And scraps come in different qualities, etc. So the chemistry also changes. So, 15% is a fair number, 15 to 20% of the nameplate that has to be struck off when it comes to, running the plant efficiently. Again, please watch out for efficiency. That is also very important because you might go up to 90-95%, but then you lose out on efficiency. We are making more than 80 grades. So all this thing combined, we are most happy if the plant runs between 80 and 85.
Sure. And so coming on to the new plant, we are quite near to commissioning now, so you might have visibility in terms of, how the scale-up will happen for the first phase. So if you can, broadly guide, say in 1 year, 2 year, how long do you think it will take for us to reach full utilization for at least the first phase of the capex? And when you say it will come in H1 of FY27, will it be, say, towards the end of Q1, towards the end of Q2? Any specific timelines you can share?
I would say the commencement should be in Q2. That's our internal target. And in terms of full utilization, I would say about 2.5 days should be the base case scenario for for reasonable utilization, and then we'll start the expansion for phase 2. And some of the utilities, etc., common infrastructure which is already being planned, keeping in mind phase 1 and phase 2.
Sure. Sir, and last question from my side. I mean, I think in the budget, there was also some announcement of removal of duty on import of zinc oxide. So is that even relevant for us, and do you think that will benefit our business also, or are there some provisions which do not allow us to take that benefit?
No, there has been no removal of duty on zinc oxide. There was a removal of duty on zinc scrap. Zinc scraps, which was last year budget, but that does not really impact us because the item that we manufacture is zinc, from which we manufacture is zinc dross. We are working with the government. There should have been removal of duty also on zinc dross because zinc dross is also a form of zinc scrap. So I believe duty should be removed when the Honorable Finance Minister has announced that zinc scraps should no longer attract duty import. It should automatically be extended to zinc dross also. We are working with the government to ensure that this is done. As and when this is done, obviously this will be beneficial to the company because our raw material cost goes down. So it will definitely be a good thing. It should have been done in the first place. It has been a slip, and now, sometimes it takes a little longer to get things rectified than one would imagine.
Awesome. That is helpful. Thank you.
Thank you. Our next question comes from the line of Darshil Javeri from Crown Capital. Please go ahead.
Hello. Good evening, sir. Thank you so much for taking my question, sir. Firstly, congratulations on a great set of results. So I'm just a bit new to the company, so pardon me for some naive questions, sir. So I just wanted to know, in terms of like our performance in Q3, we've achieved I think the highest revenue that we've ever done. But then why have we not been able to recreate the EBITDA that we've usually had in the past? So just wanted to be able to link that up to like we should get benefits of operating leverage, right? So how do we reconcile that, sir?
So you see, as we mentioned, there is a lag effect on inventories which keep flowing in. There's domestic material which is purchased, there's imports also. So all this, causes some impact on the exact translation of an increase in prices, increase in, volumes, etc., to the bottom line. I think we expect that the margin accretion which we're talking about should accrue in Q4.
Okay, fair enough, sir. So I just wanted to know, sir, in terms of FY27, sir, our plant is nearing full utilization and we'll be commissioning another plant. So any kind of revenue guidance that, we can have for FY27, sir?
So, we mentioned that our internal targets are that every 3 to 4 years max, we want to double our revenues. So last year we closed with about 857 crores of top line. And I think this year our base 9-month revenue is close to 700 crores. So I think we should be closer, if the same run rate continues, we'll be definitely over 900, 950 crores of revenue in this particular financial year. And next year also we should be able to increase by a similar number, given the growth plans that we have and the new products launches that we have in the pipeline.
Okay, fair enough, sir. And so, just wanted to know, like, when we are saying that, we want to increase our EBITDA, going forward, sir. So the new plant will be catering to more value-added products. That's one of the bigger drivers, or what would be, the top two drivers of, EBITDA margin, sir?
So it will, obviously the new plant is, in Gujarat. It has a lot of, specialty chemical companies, and a lot of our specialty customers are located in and around the western region. So the new plant will definitely cater to them, along with the tire industry and the ceramic industry, which is also in close proximity to the Dahej plant.
Okay, fair enough, sir. Yeah, that's it from my side, sir. Thank you so much. All the best.
Thank you.
Thank you. Our next question comes from the line of Dhruvin Kadakia from SKP Securities. Please go ahead.
Thank you for the opportunity, sir. Actually, most of my questions have been answered. Just one question that remains is for this year in terms of realization per tons for zinc oxide as well as zinc sulfate. What kind of growth are we seeing, and what kind of growth in realization do we expect in the coming years going forward for them?
You see, the realization per ton of zinc oxide is directly related to the prices of zinc on the LME. And if you see on a 9-month basis, there has not been much change in the price of zinc on the LME. If you see the April to December average for 24 and 25, the LME averages are more or less the same. So the average selling price per ton is more or less the same for zinc oxide. Zinc sulfate prices have increased slightly because of increase in the prices of the key raw material, which is zinc ash and sulfuric acid. In the last couple of, last 3 to 4 months, these costs have increased. So obviously these have then been passed on to the customer, and prices, the realization per ton of zinc sulfate has increased slightly over a 9-month period. But I don't have the exact number with me offhand. I can share it with you offline on zinc sulfate.
Sure, sir. That'll be all. Thank you so much.
Thank you. Our next question comes from the line of Jigna Kaliwada from Coherent Wealth. Please go ahead.
Hello.
Yes,
Please go ahead.
Yeah, I just had a couple of questions. So the first one is that you had mentioned that you are looking out for some inorganic acquisitions and you are going to announce relating to that in the coming few months. I just wanted to know what is the status of that. And the second question, I just wanted to know that what is the
Sorry to interrupt you,
capacity
ma'am, but
for...
your voice is breaking.
The voice is not clear at all.
Ma'am, can you repeat your question?
Yeah, so I just wanted...
Sorry to interrupt you, ma'am, but your voice is not clear at all. Can you move to a different environment and ask your question?
Is it audible now? Hello?
We are not able to hear her clearly. So perhaps we proceed with the next question and she joins back the queue when she has better network. Is that possible?
Yes, ma'am. Yes, sir, it works. Jigna, can you please rejoin the queue?
Yeah, sure.
All right. Our next question comes from the line of Dhiril Shah from Phillip Capital. Please go ahead.
Yeah, good evening, sir. Thanks for the opportunity. So on the YOY basis, what is the growth that we have seen on the zinc sulfate side?
On a YOY basis on the zinc sulfate side, our growth is about 3 to 4%.
So this is particularly for the Q3?
I'm talking about 9-month basis.
And in the Q3, sir?
Q3 would be similar. I mean, not much different. Maybe a percentage higher or low. I don't have the exact number offhand ready, but it will be similar.
But any particular reason why we are not able to grow double digit, on a low base?
See, while the base was low, but we must also understand that prior year, the zinc sulfate market was not good, and the last financial was a better year. So, and the company had just started that time, so we could take advantage of that. Current year, the business has not grown as we would have expected on the volumes, is because with the zinc prices going high, the farmer community is always a little more sensitive to the zinc prices, and because of sulfuric acid and zinc both going up, there is obviously a little slowness in demand. Basically, this demand has to come, but it gets pushed. So people tend to, push away the use of micronutrients like zinc sulfate, etc. They try to push it that, look, instead of putting it now, we may put it after 2 to 3 months. So as and when this comes, it will be an effect of a pent-up demand coming in. But for the time being, we noticed that there was a slight, slowness in the offtake.
Okay. And so whatever expansion that we are doing on the Naidupeta side of, let's say, 5,000 tons, so this is on the zinc oxide side or zinc sulfate side?
Currently, it's only planned for zinc oxide.
Okay, and so what is the utilization of zinc sulfate as on date, sir? Maybe 9-month basis?
Currently, we must be utilized about 60%.
Okay, and sir, you also mentioned that we are investing on the solar power, to increase our renewable, portion to the overall power cost. So what kind of saving that, we might see in the coming years, and what is the investment that we are doing on the solar?
So we've invested about 2.5 crores or so in the first phase of solar power generation. This solar power generation is expected to commence this month, and we will be going in for future expansion of our solar power generation in both Naidupeta and in the Dahej plant.
Okay, and so what kind of saving we are expecting from this, sir? And how much this will, cater to our overall power requirement on the renewable side?
So our renewable power, the share of renewable power, our target is to go up to about 55 to 60% in 4 years' time. And with phased investments over the next 3 to 4 years' time, we feel this can be done. And in terms of the saving, I would say, based on our understanding and our workings, the IRR of a solar power plant, basis the current power cost, etc., that we have, is close to about 18 to 20%. So I would say it's a decent investment if you look at it from a return on investment perspective, where the return on investment is about 18 to 20% per annum. So it's a decent saving, I would say.
Okay, and so what was the contribution on the export side on a 9-month basis as well as in Q3?
So export share is about 13 to 14% on, I would say, give or take a percent on a 3-month and a 9-month basis. And as we've guided earlier, exports will be in the range of 10 to 15%. Yes, the base gets higher, so the volume number in exports increases, but we don't expect this export share to become 25-30% in the near future.
Okay. So that's it from my side. Thank you so much, sir.
Thank you.
Thank you. Our next question comes from the line of Kaushal Sharma from Equinox Capital Venture Private Limited. Please go ahead.
Hello. Am I audible?
Yes, sir. You
Hello.
are.
Am I audible? Hello.
Yes.
Am I audible, sir?
Yes, we can hear you.
Yeah. Sir, I just have one follow-up question on your solar project. Like you have put one solar project. So what kind of margin improvement from this project and the capex and the size of the project in the phase 1 and we are also putting another phase 2 project. So what amount of capex is required and how would they impact on our EBITDA margin? So could you please explain it?
So I think I just answered this question that the first phase capex was under 2.5 crores, and we expect that the return on investment on these projects is about 18 to 20%. So I think the incremental profitability per year should be about 60 to 70 lakhs per year over the next 4 years, each year. So this will be the incremental profitability because of the solar project. I think I just answered this question in detail before this.
Okay, sir. Okay. Thank you.
Thank you. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. Participants who wish to ask a question may press star and 1 on their touchtone telephone. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Thank you. Thank you to all the participants who have participated in today's earnings calls conference. I hope we have been able to answer most of your questions satisfactorily and at the same time offer insights into our business. If you have any further questions or you would like to know something more, please reach out to our investor relation managers at Valorum Advisors. They would be most pleased to answer you. Thank you, and thank you once again for joining us today. Have a good day. Thank you.
Thank you. On behalf of Phillip Capital Private Client Group, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.